Hello and welcome back to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today. As I mentioned in the first segment, effective yesterday, October the 3rd, 2011, we would officially be in a bear market. I know people have different definitions or different markets, the S&P 500, the Dow, the NASDAQ, different things, but one of the data vendors that I use has a very specific definition of a bear market. It's that the Dow requires a 13% decline after 145 days or a 30% drop after 50 calendar days is what they define as the bear market. And lacking any better definition, that's the one that I tend to use as well. So we were talking about the fact we are in a bear market and what strategies that you may or may not want to employ. And we were talking a little bit about everyone should have a long-term, what we call strategic allocation. And this is a reflection of things like your goals, your risk tolerance, your capacity to assume risk, things like that determine, okay, well, in general, I'm an aggressive person, or in general, I'm a conservative person. And that forms what's called your strategic allocation. Maybe it's 50% growth type assets and 50% income type assets. So that's what we call a strategic allocation, and we develop those based on long periods of data. If you look since 1900, since we were talking about the Dow, I realize there's some issues with the Dow, but anyway, if we look at since about 1900, the average trend line growth for the Dow has been 6.5%. net of inflation. And that's key because inflation varies at different times. When you have higher inflation, your stock returns are going to get a natural boost. When you have low inflation, they're going to be down. So what we do is we strip out inflation to get that average trend line growth. And it's averaged about 6.5% since the early 1900s. And when you look at the average dividend yield, plus the expansion in the PE is how you get 6.5%. Anyway, that's for another show. I don't want to get too much into that right now. We're talking about is your strategic allocation. If you look at the long-term returns of bonds, you get one number. If you look at the long-term returns of commodities, you get another number. And so historically, stocks starting from a low PE or low valuations have returned much better. If we look at the bond market today, we're coming off of very high interest rates in the 80s down to virtually nothing today. And the best indicator of the future return of the bond market is actually the current yield. And so when we're building our models, we would assume that going forward, the return on 10-year treasuries would be somewhere around 2% because that is what the yield is today. So we look at all these different factors and then we come up with what's called a strategic allocation. And it's generally been fairly accurate at predicting returns over, longer periods of time, say 7 to 12 years, looking at fundamental data, growth rates, starting price to earnings, starting inflation, starting interest rates. You can get a general idea of what the next, say, 7 to 12 years is going to be. However, over the shorter term, say the 1 to 3 year time horizon, these things can change very significantly, and that's what we're seeing right now. If you go back to the year 2000 and you looked at the valuations of the market, you looked at the bond yields and things like that, you would have predicted, as many did, that the decade of the 2000s would be very poor returns for the stock market, which is in fact what happened. So as we look forward out 7 to 12 years, we see that the bond returns are probably going to be fairly low. In fact, after inflation, you're not going to be much return in the bond market at all. In the stock market, maybe smaller companies are a little bit overvalued, although some of that's getting worked off right now. But if you look at emerging markets, you look at U.S. large companies, and to some extent U.S. European companies, you're going to expect those to have an above average rate of return because they're starting from such a depressed level. Now, all this is great looking out 7, 10, 12 years, but what do we do in the interim? And that's where you have some sort of a tactical view of the market. Is what is happening today? How do I want to allocate my capital? Do I need money in the next several years? Which, by the way, if you do need money in the next several years, that money should not be exposed to, it should be exposed to as little risk as possible, invested in things like short-term bonds and so forth. Any money that you do not need for several years, you can venture out into the marketplace, into growth assets, stocks, bonds, commodities, real estate, and fixed income. Well, today, so the tactical outlook is very poor. When you're in the midst of a bear market, the tactical outlook is very poor. The trend in virtually every market is down. We have many models that we use that are updated on a monthly basis. In fact, our commodity model at the end of September, its rating is from 0 to 100, was 0. I mean, some of our models are so bad that part of me thinks it's actually good. It's so bad that it's good. But the fact of the matter is that most markets are in a downturn. And if you have a low tolerance for risk, or you don't like seeing your balances go down on a regular basis, you may want to take some action to what we call hedge your portfolio. We're coming up on our next break, so when I come back, we'll talk a little bit about some of the tactical moves that you may want to make to protect your portfolio. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages.